So, good morning, or good day, or good evening, whatever time it is when you see this. Let's go on talking about vouchers. To give you the overview, we have already seen a bit of details concerning vouchers till the basic definition, the overview about the basic types, and so on. And now we are going to speak in detail about single-purpose vouchers. That is, as you remember, single vouchers were those vouchers where the conditions about what you get later are so precise that you can determine the tax rate and the state, so the exact conditions which are relevant for the VAT treatment. This is a single-purpose voucher. You can issue such vouchers naturally for the delivery of goods later or for the supply of services, or you could have a combination naturally. So let us first deal with the vouchers for the delivery of tangible goods. The treatment is basically easy. Selling the voucher is already a taxable transaction and is taxed as if there were a delivery already of the good in question or the category of goods in question. If you later then hand out the goods in exchange for getting the vouchers, this is then no taxable transaction at all anymore. So two stages, two transactions might exist in your minds. For example, you have a bookshop owner. He issues a voucher for books with a nominal value of €50 to a customer. That customer pays €50 for it. That is already a taxable transaction. Later, the bookshop owner hands over books to the customer, gets the voucher in return for it, and this is then no longer a taxable transaction. So that's why I crossed out that second transaction from the sketch. So only number one will be relevant then. So the rules are simple. In cases where the value of the voucher does not cover the whole price of the good, that's the next idea. Then the amount of the voucher will not be considered as a part of the consideration for that transaction again. So in accordance with our idea is accepting the voucher no longer a taxable thing. So if you accept the voucher plus cash, then only the cash part of the transaction is the second transaction, which means if we make a sketch again, you have the first transaction, the bookshop owner issues a voucher, €50 nominal value, to the customer. Customer pays for the voucher. This is taxed at the same conditions as selling a book. So 7% out of 107% are the VAT on that 50%, €50 voucher. Then the bookshop owner later hands over books with a value of €53 to the customer. The customer hands back the voucher plus €3. Then we have two parts of the transaction, €50 in form of a voucher and 3 in form of cash. And the €50 part of the voucher of the transaction is simply ignored because it no longer exists. So what we have in the second transaction here is only selling books for €3 gross amount. The €50 voucher part is completely ignored from the whole thing. Okay, basic, nice idea. No? So should be understandable, at least I hope. So that's why I just cross out the 50 from the €53 consideration. Basically, what the bookshop owner then now does is simply handing over books for €3 from the perspective of VAT, because the remaining part has already happened before. Okay, now selling such a single purpose voucher on a good to somebody else is taxed as if the underlying good had already again been sold. So imagine we have this: the bookshop owner issues a voucher to a customer number one. Customer number one pays 50 euro for it. Then customer number one hands over that voucher for books to customer number two as a birthday present. So you have two deliveries of that voucher. The first one is a taxable transaction because it's done by an entrepreneur. The second one, in my example, is not a taxable transaction at all because customer hands it over to customer. It's a transfer of ownership, however, not taxable because the second transaction is not done by an entrepreneur. If the second guy were an entrepreneur himself, then the second delivery would also have to be tested for taxability. So again, handing out the goods in exchange for the voucher is again no taxable transaction anymore. So a bookshop owner hands the books to customer two, gives back the voucher, no tax consequences anymore if the voucher's value corresponds exactly to the book's value. So here's nothing. Okay, good. Then, important for the treatment of vouchers concerning goods. When you sell such a voucher, the underlying goods are never moved to any customer. So, the basic rules for the place of delivery of a good are either 3.6 if the good is transported in any way in connection with the delivery, then it's 3.6 where the movement of the good towards the customer begins. However, if there's no movement connected to that transaction, then 3.7 says, okay, the place of the delivery is at the place where the good is at the moment when the transaction happens. And this system leads to fitting consequences, which are economically fully correct. For example, imagine you have a shop in Aachen, which is a city in Germany. They sell a voucher to a German who wants to go as a tourist to the USA. And this voucher has been issued by a US firm and can only be redeemed for shops for goods in shops in the USA. So the place of delivery where these goods will be bought can only be the US. So it will be a third country. So the place of delivery where the goods are at the moment when the voucher crosses ownership, crosses hands, is the USA, and that means the voucher is not taxable because its place of delivery is under 3.7 USA. Now, the same shop in Aachen, imagine it sells now a voucher which can be handed in shops in several cities of Germany. For example, Aachen, Cologne, Düsseldorf, Munich. The place of delivery of the voucher can be determined correctly enough because it's clear that all these places where you can later buy the goods are only within Germany. So Germany is clearly enough the place of delivery. And so wherever later you will go into a shop under 3.7, even if you can't specify which city it is, you can precisely enough determine under 3.7 the place where the good which you later get in return for the voucher will be taxable is a place within Germany. So clearly enough determined, that means 3.7 place of delivery of the voucher is Germany. This voucher is taxable. Now it might naturally be imaginable that the shop owner in Germany now gets a bit mad and says, now I'm going to design a voucher with a combination. This voucher can entitle its user to hand it in for the purchase of goods in Germany or in the USA. In that case, the place could be the Germany or the USA, and in that case, it's a simple consequence. The conditions under which later the delivery will take place and which state will get the right to tax are not clearly determined enough anymore. So in that case, we don't have a single purpose voucher anymore. This would be a multiple purpose voucher, and you know the rules for these are different. So easy. Huh? You can now easily imagine what would happen if a shop in Germany issues a voucher which can only be redeemed in shops in France. Then the place of delivery would be under 37 France, because all the goods, whenever you can buy them with the voucher, place of delivery would be France, so place of the voucher is France. Good. Interestingly, this system of treating single-purpose vouchers even leads to correct results when you have situations where the voucher has been issued for a price below its nominal value. Because you can imagine somebody is in urgent need of money, computer retailer, for example. Now he starts a marketing campaign. He sells vouchers, vouchers, vouchers with a nominal value of 500, but for a price of 300. So the first step is the computer shop owner sells a voucher for computer stuff, 500 euro, to customers. Customer pays 300 for it. And then later, customer shows up and buys a computer with the price of 630 by handing in the voucher for 500 and paying the remaining 130 in cash. So computer goes to customer. Customer gives voucher. We split it up again in the part which is constituted by the voucher handed in. 500 are credited in exchange for the voucher. Only 130 remain to be paid in cash. And according to our rule that transactions paid for with a single-purpose voucher do not longer exist, the 500 euro part of the transaction is completely cancelled out. It does no longer exist. What is taxed now is a payment of 130 for the computer. The rest is ignored. So the 130 are the decisive point. Taxed now is 130. And when you compare this to what economically is correct, and you see on the left side, selling a computer with an official price of 630 for a reduced price of 430 would be taxed as 430 is a gross price. You calculate the net price out of the 430. You take 19% on the net price of the 430, and you end up with the correct tax, 19% on or out of all what the entrepreneur has effectively received in exchange for the computer. If you look to the right side, you see what happened in our voucher for lower price model. You issued a voucher for a computer with 500 euro nominal value. You sold that voucher for 500 at a price of 300, so you effectively got granted a price reduction of 200, and subsequently sell the computer for 130. So first you tax here the 300 for the voucher, and then you tax the remaining 130. So basically what you tax is 430 in total gross price, and this is evidently exactly the same. Yeah? So the result is still even adequate if the price reduced voucher has been sold on several times within the chain in the meantime. For example, if for a marketing campaign a computer retailer, same guy as before perhaps, issues vouchers with a nominal value of 500 for 300, and he sells them to various retail shops in the region like groceries, bakeries and fuel stations with the task, please try to sell it on to people who are interested. These people resell the vouchers to their customers for a price of 350. In that case, later the customer shows up at the computer seller's shop and buys a computer for a price of 630, handing in one of the vouchers plus 130 in cash. How will that sequence of events be treated under our voucher rules? And the answer is, let's have a look. The original sale of the voucher for 300 gross by the computer seller is taxed with on the basis of a gross price of 300. Then the computer seller hands over an invoice confirming that transaction to the, let's say, fuel station owner. The fuel station owner sells, naturally, the voucher to the private customer, for 350. So he pays tax on 350 and gets back the tax which he paid to the voucher issuer as input tax. So now we end up with a definitive tax of 19% on 350. Next, the private customer shows up with the voucher and tax is paid on 130 gross value by the computer shop owner. So in total, the private consumer has paid an amount of 350 plus 130 gross price 480, and the tax was valued on the 130 and on the 350. All the rest was cancelled in the chain. So evidently we have the correct result. All what the consumer paid as a gross price was indeed taxed with VAT, and all VAT within the chain of enterprise owners was effectively correctly cancelled out. So everything works fine. Perfect. However, last but not least, a few things should be noticed. That is first, our remarkable fact number one is a voucher sale is always under 3.7, so without movement of a good. So a voucher sale can never entitle to a tax exemption for exports because an export requires that together with the sale, with the delivery, there is a movement of the good across the border from inside the country to outside the country. The same with an intra-community delivery. So this is impossible in a 3.7 situation. So that means a voucher can never be tax-free as an export to a third country or intra-community delivery because or even if the later good which you buy in return for the voucher is carried outside the country by you. So, for example, buying something in a duty-free shop at a German airport, if you're a third country citizen, paying with a voucher and then leaving the country would be a bad idea because you don't get, or the seller doesn't then get the tax exemption for exports. Naturally, a reasonable seller would never then issue a voucher for things like these. Number two, if you are an idiot enough to be an entrepreneur and buy a good in another member state with the help of a voucher and then carry it over the border into your own member state, then this would still qualify as an intra-community acquisition of a good. And then the voucher would not be cancelled out from the tax base, but the intra-community acquisition of the good would remain fully taxable. This means you would be an idiot to use a voucher for such a purpose. So the solution for this awkward situation is evidently first, don't be an idiot, don't use vouchers for cross-border transactions if they are single-purpose vouchers like the one in question. And one might even doubt if in such a situation the voucher in question is actually clearly enough determined to qualify as a single-purpose voucher. However, if it has been qualified as such, then it would be idiotic to use it for cross-border deliveries or intra-community acquisitions. Good. Number three, naturally, if you sell a voucher for a price now and it becomes taxable now, then the tax rate of today applies and becomes definitive because handing in the voucher later doesn't count anymore. That's the one and only difference to making a prepayment. When you make a prepayment now, it's just temporary. And when later the actual transaction is made, the actual transaction is fully taxed and the prepayment and the prepaid tax is just netted off against what is finally due. So this could be of special interest wherever a tax rate is going to increase. Because imagine our German government had a good idea and it dreamed about increasing the tax rate, presently 19%, to a fantastic future 25% next year. Now, if you know that in advance, you might come to a clever tax saving trick. You might issue vouchers, vouchers, and vouchers for consumer goods to your customers. Buying 10 vouchers for a nominal rate of nominal value of 100 now, still at the rate of 19%, would enable you to buy with these vouchers next year goods still taxed at a rate of 19%, although the rate has risen in the meantime for 25 to 25%. So it would be a means to carry over a present day tax rate to the future. However, this does not fully fit into the system. However, it basically doesn't give you any opportunity or every chance to behave, which you don't have now, because what do people do usually when they hear the tax rate is going to increase and it's about consumer goods? They will probably, if they are clever and have enough money and the goods don't perish over time, they will simply buy goods now and put them in stock to have them later. So this effect of a voucher is nice. However, it doesn't bring along the breakdown of the whole system, because it's basically a possibility which is already built in the system already now in normal situations without vouchers. Okay. However, keep it in mind, might be nice. Naturally, if a voucher is now sold to somebody else and that other person is an entrepreneur, then you have to issue an invoice, or have to be able to issue an invoice with an open confirmation of the VAT contained in the voucher's price, so that the recipient can correctly claim input tax for that VAT. Because later he won't get any invoice stating confirming VAT when he hands in the voucher to pay for a computer or for a printing machine or something like that. So you need to be able to issue an invoice now. Now the trick comes up. If the voucher which you sold would have been now a multi-purpose voucher, then selling the multi-purpose voucher does not yet trigger VAT. So confirming VAT in an invoice about a voucher, if that voucher was not correctly qualified as a single-purpose voucher, would be a case where you confirm VAT without being able to do so. So it would bring along the applicability of paragraph 14c USDG or the equivalent rules abroad. You confirm VAT, although there is no VAT due. That triggers VAT duty for the person issuing that invoice, and that spoils input tax deduction for the person receiving that input. For that reason, it should always be absolutely clear if a voucher which you sell is a single-purpose voucher, triggering VAT, or a multi-purpose voucher, irrelevant for VAT. So that means, number 6, the fiscal authorities, at least of Germany, strongly recommend, that means basically they insist in, but they can't enforce, that every voucher should bear a remark which clearly states, I am an Einzweckgutschein, a single-purpose voucher, or a multiple-purpose voucher, Mehrzweckgutschein. So I carry VAT or I don't carry VAT. No? Good. So this should be sufficient as first impression on vouchers for goods. And now let's go and speak about vouchers for services. Which additional problems come up there? That's a question. So, to begin to talk about vouchers for services, let's rethink what do we need in order to be able to classify a voucher as a single-purpose voucher. What we need is we need to have exact information about the rate which should be applied later to the final service which is rendered. And in order to know the rate, we also must be sure about the state which gets the tax. So that means that the place of the service in the future must be sufficiently known in order to be sure that it's a single-purpose voucher. That in turn means we have to have all information to find out which possible places of service might occur under the rules of 3A, 3B, and so on. And yeah, as you will remember, the general rules in 3A are different depending on whether you are an entrepreneur or a private customer. So that's probably something which you have to think about. Are both categories possible? And for example, if the customer is also a business customer, will then be the place inside Germany? Or in cases that you render a service which might be listed in 3A, let's say 3A3, let's say catering services or something like that, can we then determine the place sufficiently enough? Now, you also need to know some of the rules in 3A only apply if the customer is a private customer. Sometimes we have also a rule which also applies only if the customer is an entrepreneur. For example, a special rule for the treatment of entrance cards in 3A3 number 5. Or sometimes rules only apply if somebody is a non-entrepreneurial customer from a third country. So for the treatment of a single-purpose voucher, which also entitles to obtaining services, it is vital to be sure that all potentially applicable rules for the place of service lead to the same state as place of service of the voucher. Yeah? Otherwise, it would be a multi-purpose voucher. So if you want to make a voucher already taxable, you should design the conditions for redeeming the voucher in a way that only one place or region of is possible for the place of the service, so that all potentially applicable rules lead to the same overall result. For example, place must be in Germany, irrespective of which rule applies in the concrete case. So only, but always, if the place of service can be determined clearly enough so that always the same outcome is there with regard to the state, then we can treat it as a single-purpose voucher. And then the rules are basically the same as before. So selling the voucher is already a taxable transaction and is treated as if you already sold the underlying service. Selling the voucher to another person in the chain of entrepreneurs is again a taxable transaction. The place of the sale of the voucher must always be determined according to where the final thing happens. And redeeming the voucher at the end is not taxable anymore. And if there is an additional cash, then only that additional cash is considered as a taxable transaction in return for that part of the service which you get for this cash. Now let's have a closer look to how trade with vouchers can happen. First, the easiest way is the trader can buy a voucher issued by a deliverer, provider of a service, and then sells this voucher on to a customer. So the contractual relationships will now be A is the vendor of the good or service. Issue the voucher. I, A, hereby promise to whoever will in the future, before the end of eternity comes, present this voucher to me or my legal successors to do this and this and this. And he sells this to B, a trader. B trades vouchers, for example, is a portal where people can buy vouchers, and B then sells on the identical voucher in his own name to the customer. And this voucher still bears the text, I, A, hereby promise to do so. So what he does is he buys a voucher and resells it. We have two independent transactions. Let's say the first transaction happens in January, then the first sale of the voucher becomes taxable. The second transaction happens in April when somebody buys the voucher from B, and at that time we have a second transaction. When later the voucher is handed in, we don't have any transaction anymore. It might also happen, number two, second alternative, that entrepreneur B might issue a voucher in which he, that's B, promises in his own name, I, B, will take care that you can get a service from A. In that case, what you first need is an agreement between A and B. B is allowed to issue a voucher where he makes a promise, and this voucher will be redeemed by A if that voucher is presented to A. So that agreement between A and B is not yet a voucher because nobody can present this. And now B issues a voucher. I, B, promise now hereby to you, Mr. C, or whoever, to the owner of this voucher, that you, C, or your legal successor can present this voucher to a person named A and will get a good or service in return for it. In that case, what we have here is the rules for non-disclosed agency. B makes a promise in his own name, but the person actually obliged by this, actually doing the service, the person for whom he basically acts, is A. So the fiscal administration says, and they say it correctly, that in that case, we have a case of non-disclosed agency. The person who promises a sale or a service is not the person who really later does it. So we split up the contract into two identical contracts, A to B and B to C, and these contracts happen not before the whole thing starts. They happen at the same time because when B issues the voucher in his own name, then at the same moment it's also deemed that A got the identical transaction, so sale of a voucher, that this happened between A and B at the same time. So that contract A to C, that's how later the thing is done, is under non-disclosed agency split up. A does it to B, B does it to C. So this happens then both at the moment when B issues the voucher, because as you see here, the previous agreement, you can issue a voucher, is not yet a voucher. Good. Now, last alternative, B might also sell vouchers of A to customer C, but act in the name of A. Then legally, B is merely an agent and is completely out of the contract. An agent doesn't enter the contract. He's just establishing the contact between the two contract partners. And that would mean B doesn't buy or sell a voucher at all, but B only acts as an agent for A and gets a commission from A for being successful. So the contract relationships would then be in our sketch as follows. A is the vendor of a good or service, issues a voucher, I, hereby promise to do something, and his customer is immediately C. And B comes into play only as an agent. He renders a service, that is, trying to find a customer for A, the vendor of the voucher. And the point of time when these things happen is when the contract is established between A and C, because only then B has already fulfilled and only then has fulfilled its obligation to A. Now, what we have here, the payments. Let's say the voucher is over or sold for a price of 100. C pays to A 100 because A is his contract partner. B gets a commission from A, or let's say 20 euro, 20%. The contract only happens, so the tax only becomes due when the contract is established between A and C. And also at the same time, the contract B to A is performed, and then the tax on the 20 gets due. Because these things only happen when a customer is found. Now, very often in practice, this is organized in a simplified way because B, the agent, sells the voucher and accepts the 100 euro in the name of A. That doesn't change anything because it's still A who gets the money because B only accepts it in the name of A. So legally, customer pays to A immediately. Now, if I accept money in the name of somebody else, I have to pass it on to that person. Now, if I have a claim of 20 to that person, probably that person says, keep the 20 and give me the rest. However, that keep the 20 and just pass on the rest is A's permission or A's way to pay me the 20. So nothing happens, nothing changes, nothing else than before. If you have this idea, B collects the money and hands it over minus his commission. So customer C pays 100 to A because B only accepts in the name of A, so it's A legally who gets the 100, as in the sketch shown before. And A pays the 20 to B because when A gives B the permission, keep 20 out of the 100 and give me only the rest, then this is just the way how A pays B for his services. These three different constellations are basically what can be distinguished if you trade in vouchers. So selling on a voucher without modification, issuing a voucher in your own name, but selling the service of somebody else, that's non-disclosed agency, and third but not last, acting as an agent. So that's basically what you have to distinguish. Thanks for watching today, and goodbye till next time. I hope you enjoyed it, and I even more hope that you understood it a bit. Thank you very much. Till next time, goodbye, enjoy the rest of the day, and don't stay away from the channel but come back. Recommend it to others whom you like or to those whom you don't like, depending on the circumstances. In cases of doubt, just recommend it to everybody whom you know. That can't be wrong. Okay, ciao.